Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around us every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can listen to all of our podcasts at americastalking.com. To support Everyday Economics and podcasts just like this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Thursday, August 24th, and joining me is Dr. Orphe Divounguy, my partner and friend. He's also a PhD economist, and he knows some things. Dr. O, why is it that the Jackson Hole Federal Reserve Summit is like the Met Gala for American economists? You know, why do we, why it's just such a showy event? I mean, they have it up in this is like our Davos, kind of moment. They're not holding this thing in St. Louis. That, nothing against St. Louis. They're not holding it in Detroit. Nothing against Detroit either. But they're off in Jackson Hole, and everybody's walking around in their Ralph Lauren cowboy, outfits and whatnot. Why do people care about this event? Why is it so important?
Well, the Federal Reserve Bank of Kansas City hosts dozens of central bankers and policymakers, academics, economists from around the world at its annual Economic Policy Symposium in Jackson Hole, Wyoming. And it's a beautiful place. I'm not invited, so I can't tell you anymore. But here's what I can tell you. The Fed chair is going to...
Well, this year you're not invited. I mean...
I'm not.
Okay.
I am not. But I can tell you that on Friday, Fed Chair Jerome Powell is going to be talking. And there's been growing disagreement at the Fed. Right. There's a new paper that just came out from the Fed, in fact.
There's some spirited disagreement that we're able to see from Fed notes.
From Fed notes, from the dot plot, you start to see kind of a divergence. And by the way, I think it's a good thing. What was a really bad thing was the fact that everybody was behind this transitory word, right? That delayed the Fed reacting to rising inflation in 2021, right? The Fed was late to respond, and so we end up with inflation above 9%. Anyway, the fact that there's disagreement is, in my opinion, a positive development at the Fed. But the disagreement is mostly around inflation, right? You got some people who say inflation's on the path to 2% and below. The economy is slowing down. And some of them are basically still the same people, right? The transitory folks. And then you have some of the people that are very, very, very clever, who are saying, look, monetary policy has these lags, right? And the lagged impact of monetary policy on the economy is going to play itself out, and that's going to slow down the economy even more. There's some people that are saying, look at what long-term yields are doing. The Fed can't really control long-term yields. It can control the short-term yields by raising the Fed funds rate, but it cannot control the Fed funds rate target, but it cannot control long-term yields, and long-term yields are rising. You're looking at above 4% U.S. Treasury, 10-year yield on the U.S. Treasury. You're looking at mortgage rates at 7% and above. And so that's also going to slow down the economy, right? And so you have those people who believe that the economy is slowing. And then you have a group of folks that is looking at recent economic data and saying, look, hold on, be careful. It seems like the economy is reaccelerating, and there's a ton of upside risk on the inflation front. Why is there so much upside risk on the inflation front? Because labor demand is still way above labor supply, right? And where's the labor supply going to come from? Is what some people are saying, right? Labor force participation has been flat. Labor supply is not growing all that much. The labor market is really still very tight. And that basically means there's a ton of wage pressures. And when wage growth increases, right, when there's a ton of wage pressure, right, businesses have a tendency of raising prices, right, because their costs have gone up. So they pass their costs on to consumers, and you can get that feedback effect, that feedback loop where you basically have, right, higher wages, higher prices, and inflation surging. We have retail sales coming in really hot. We have the services sector still in very strong, pretty good shape. I mean, pretty good, still somewhat heated. You have, housing starts increasing. So the housing market has already bottomed and is coming back up. Rent growth is actually pretty hot. It was actually pretty hot in July. Interesting. Market rent growth was actually pretty hot in July. Above expectations. And so, so you have all these factors. By the way, I should mention housing prices, of course. Housing prices, because of the supply constraint, still very hot, right? So you have all these factors that are causing this disagreement. But what's interesting about this paper that I read is that the inflation, the disagreement about inflation can only account for about 1/3 of the policy disagreement.
That's the fascinating part.
I think that's fascinating.
Yeah, I agree. So what's the other 2/3?
Well, basically, it could be, right, is what the paper says. It could be that some of this disagreement could be related to policy preferences. Yeah, I think that's very interesting. You put humans in the mix, right? Policy is not made by robots, not yet anyway. You put humans in the mix, and you have the facts, right? And you also have preferences, and I think what's crucial here is that people don't lose track of the fact that basically deficits are higher than they were in the 90s or even 70s. The U.S. deficit is 5.4% of GDP right now. That the debt to GDP ratio is about 119% of debt is 119% of GDP today compared to 65% in the 90s, and that this is not likely to improve much soon, right? I think the federal deficits are too high, debt still too high, and that as long as there's a ton of pressure on aggregate demand to continue to increase, right? Without the supply of workers, we're likely going to see, right? And by the way, why is there no supply? The outlook for the labor supply so dim? Well, we have an older population. We have a bunch of people who retired. America's population is aging. Older retired workers are going to require more healthcare benefits and Social Security and all these things, right? So the size of government.
And some would argue that we, on sort of with younger people, with regard to the extension of entitlements, that we've not created an environment where working puts you in a much different situation than not working financially.
Well, exactly. And I won't go into the details, but here's the thing. And that prevents savings from increasing.
Of course.
Right? Desired savings from increasing. And so you have a situation where you have higher desired investment relative to savings. And so that is going to continue to push inflation and rates higher. And so perhaps, some people are saying, perhaps the Fed funds rate is not high enough, and that maybe Fed policy is not restrictive enough.
We're taping this show on Thursday. The Fed meetings start Friday, the Jacksonville meetings, and Jerome Powell will speak, if not Friday, then Saturday.
I think it started today, but I think Powell's scheduled to speak on Friday, tomorrow.
Thank you for clarifying. What do you think Jerome Powell's going to have to say? You have some people who are paying attention to the markets are really uneasy, because if Jerome Powell goes too far one way or too far the other, it's going to have an impact on the market. The market overall is sort of in a, I don't know, like a
holding pattern.
Yeah,
a holding
right,
pattern.
Yes,
right
but there's
now.
a lot of buzz. So what do you think Jerome Powell's going to say?
I don't know what Jerome Powell's going to say, but here's what I can tell you. There's no free lunch. There's no free lunch. Ultimately, I've said this before. I think the Fed needs help from the federal government, the local government, and the state and local governments. The Fed needs help on the fiscal policy front in order to bring inflation under control, not just for now, the short run, but over the long run. And it's not getting that help yet, right? And so as long as fiscal policy remains somewhat loose, then upside inflation risk will remain. And we better get used to higher inflation and higher rates, higher interest rates, because that might be in our near future for the time being. And so we'll see. I think investors are going to be paying attention to what Powell says in terms of inflation, in terms of real rates. And of course, if interest rates, if yields start to bump up, don't be surprised. We came out and said it first. It's going to definitely cause the stock market to have a bad day.
Well, I appreciate your thoughts. I don't appreciate that thought specifically at all, but in general, of course, thank you for imparting your wisdom upon us. For Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.